China's consumer prices slid into deflationary territory in July. And as economic woes continue to cloud hopes of a recovery, President Joe Biden is calling out the world's second largest economy. Biden said China's economy is in trouble and fears the country is, quote, a ticking time bomb over its slowing growth and high unemployment rate. Now, that's according to a pool report of the Thursday fundraiser that took place. He went on to say they've got some problems, and that's not good because when bad folks have problems, they do bad things. Erik Nelson is still here with us. Okay, so a bit to unpack there, Erik, and perhaps we start with the data and what the data has been telling us from your perspective out of China thus far.
Well, it's not been great, Brad. I have to be honest. What's shocking to me about this whole thing, because you look at the activity data, you look at the credit data just this morning, the overall, I'd say, I'll call it the vibes from China's economy are not good. So I'd say what's concerning here is Beijing is certainly not taking the action it needs to, given the weak demand picture, the weak activity picture. And that's really concerning because you have a reopening economy here. We thought this was going to be the big growth story of 2023, and it hasn't come to fruition. If China doesn't do anything, the risk is you have a downward spiral here in activity, really predicated on this idea of the property sector being the lead sort of problem when it comes to medium-term activity. There needs to be some big action here from the central government. They need to counter the deleveraging that's happening in the private sector. And until that happens, it's going to be continued weakness out of China. I think even easing from the People's Bank of China, the central bank, rate cuts probably aren't enough at this point. You really need to see something on the fiscal side to counter this weakness.
And we've talked to some other folks on the show who have said that even if the Chinese government does take certain measures, particularly with the property sector, that the dynamics this time are such that it might not even be as effective as it was in the past. So, if that's the case, what's the risk that they just if they don't do anything or if they do something small, then what's the scenario?
Yeah, there's a lot of parallels being drawn to Japan in the 1980s and the bubble that burst there, given the extent of credit expansion that we've seen in the last 10, 15 years. And what's really changed here from a structural standpoint in terms of Beijing's priorities is deleveraging. This was never really on the radar for Beijing. If anything, it was leveraging. And that's what's concerning here about the sort of piecemeal small steps the Chinese government is taking. It tells you that they're really trying to push this deleveraging, which is not the stance you want to see when you're looking for growth. Do I think there's going to be a real credit collapse here? I mean, it's certainly possible if China continues to sort of step back and let things happen. That was really, I think, what people agree would be the policy mistake of Japan in the 80s, 90s was really not recapitalizing the banking sector, not taking swift action when it was needed. So even if that's the case, it's going to take a long time to play out. And I'm hoping that Beijing will be a little more proactive on the policy side before that. But that's the fear here, I think, is a real credit collapse.
So the other kind of thing about the environment in China, too, right now is the number of U.S. companies that had also kind of banked on projections that this would be a huge bounce back here, right? And so we're not seeing that in the data that's coming forward. So does that mean so much of the purchasing or the spend or that demand has been pulled forward and thus we're kind of just looking at a normal to perhaps slightly above normal environment? And then what does that mean for 2024 for companies who had kind of baked that into their forecast for this year and that are missing out on that?
Well, I think what's concerning here is if you actually look at the numbers, credit data this morning, a great example, you actually had the weakest loan demand since 2009 in the data numbers this morning. So it's not even as if we're just back to a normal rate of growth in China and that you didn't see the explosive rate of growth we expected. Things are really underperforming here. Mm-hmm. So that is the concern, I think. And when we take a step back and ask the question, well, what's it going to take for Beijing to step up and the government to really enact full big stimulus? I think you have to look at the labor market, unemployment rate. That has been actually pretty well behaved despite all the weakness in growth. And if you look at some of the PMIs, the services PMI just this past month showed employers are still looking to hire. So with that backdrop, there's not a lot of urgency for Beijing to step in and take swift action. If that changes, though, and that will change if there continues to be credit deleveraging, that could be with a catalyst maybe for some real action here.
Hey, Erik, the other thing that caught my eye this morning was some commentary that President Biden made about China, where he called the economy there a ticking time bomb, or the economic problems a ticking time bomb. He criticized leadership there, as he has in the past. And so that makes me wonder sort of what the tension between the U.S. and China is going to yield in terms of perhaps exacerbating the economic pressure there. Is that something you see happening?
Well, I would say actually, if anything, the mood music between the two countries from an economic standpoint has gotten a little bit more positive. And that's welcome, obviously. Some of the spy balloon issues that cropped up a few months ago, seems like the two countries have sort of come to an agreement or can put that behind them. So generally speaking, the overall discussions have become more constructive. From a trade standpoint, the U.S. is still importing a lot from China. Despite all the talks of reshoring, friendshoring, China remains a very important trading partner. So in terms of the hard data, the relationship is still pretty strong. And I think that in general is what's driving this continued positive movement in talks, the realization that the two are very reliant on each other. And I don't really see that changing materially anytime soon. So that does limit the extent of substantial financial market volatility from Chinese weakness and also fallout to say the Chinese currency, for example. We think that's going to get a little bit weaker, but we're not in the 2019 environment where there's real big headline risk on the U.S.-China relationship, at least from my perspective.
Erik, thank you so much. Appreciate it. Erik Nelson, Wells Fargo Securities macro strategist. Have a great weekend.
Me too.